There's a rule named after a golf tournament that pays you tax-free. Hi, I'm Sherry Ayland. I'm a CPA and tax advisor, and I help my clients pay little to no taxes using my zero tax blueprint. There is a rule in the tax code named after a golf tournament that lets you pay yourself tax-free rent from your own business. It's completely legal. The IRS has blessed it for decades, and almost nobody uses it correctly, either because they've never heard of it, because they're doing it wrong, and setting themselves up for an audit. So let's fix that. This comes from Section 280AG of the Internal Revenue Code. The nickname comes from homeowners near the Masters Golf Tournament in Augusta, Georgia, who rent out their homes for tournament week and don't pay a dime of tax on that income. Here's the rule in plain terms. If you rent out your personal residence for 14 days or fewer during the year, that rental income is completely excluded from your gross income. Not deferred, excluded. Most people think this only applies to renting your house to strangers during a local event. But if you own a business, this rule becomes a legitimate strategy to move money from your business to yourself, tax-free on your end, while your business gets a deduction. Here's the mechanics. Your business rents your personal home for a board meeting, a strategic planning session, a team retreat, or a client event for a legitimate business purpose. Your business pays you fair market rent for that use. Your business deducts that as rent as a business expense. You personally exclude that rental income entirely under Section 280AG as long as you're within the 14-day limit for the year. So the money moves from the business's taxable side to your personal side, and it never gets taxed on the way. That's the entire strategy. It almost sounds too simple, and that's exactly why the IRS scrutinizes it, because it is simple and it gets abused constantly by people who skip the substance and just chase the paperwork. This is where most people get it wrong, and it's the single biggest audit trigger. The rent your business pays you has to reflect fair market value for comparable space, not a number you made up because it sounded good on a spreadsheet. You need actual documentation, full comparable rates for event venues, meeting spaces, or short-term rental listings of similar size in your area for a similar type of use. If a comparable venue rents for $1,500 a day for a corporate meeting, that's your benchmark, not $5,000, and not some arbitrary round number your bookkeeper picked. Save the comps, screenshot them, date them. This is the first thing that gets requested if this deduction ever gets questioned. And I just picked a number is not a defense that holds up. Fair market rent alone is not enough. You need a full paper trail showing this was a real business event, not a disguised distribution. Number one, board minutes or a written resolution authorizing the rental and stating the business purpose. Number two, an actual rental agreement between you personally and your business, even though you're on both sides of it. Number three, an agenda for whatever business activity happened that day, what was discussed, who attended, what decisions were made. Number four, proof of payment. The business actually has to cut a check or wire to you personally, not just a journal entry. Number five, a log of all rental days used during the year for that property, since the 14-day limit applies per residence. If you own more than one qualifying residence, each one gets its own separate 14-day allowance. If you can't produce these 5 things for every rental day you're claiming, you don't have a defensible Augusta Rule position. You have a red flag. Here are some few ways that this goes wrong constantly. Renting for personal sounding events. A family birthday party is not a business meeting, even if you technically discussed work for 10 minutes. Exceeding 14 days. The exclusion is all or nothing for the year, not prorated by day. Rent your home for 15 days at $1,000 a day, and it's not just that 15th day that gets taxable. The entire $15,000 becomes reportable rental income on Schedule E. One day over the limit changes the tax treatment of every day you've rented. Now, renting a home you don't actually use as your personal residence. This only works for your actual home, not a property you own but don't live in. Next, no corroborating evidence. No agenda, no minutes, no comps, just a rent check that magically appears every month. That pattern alone invites scrutiny because 14 real business events a year should look occasional, not routine and identical. Done right, this is one of the cleanest tax-free income strategies available to business owners, a few $1,000s a year, completely excluded, funded by a legitimate business deduction on the other side. Done wrong, it's an easy target because the whole thing hinges on documentation you either have or don't. If you want to know exactly how to structure this for your business, board resolution language, the rental agreement, the comp research, that's exactly the kind of thing worth getting right with a CPA before you claim it, not after. Subscribe for more strategies like this every week.